Right, those were the top headlines that we are tracking for you at this hour. And let's get started with the global markets. Now, global equity markets have seen a clear shift since February 28th, tracking the escalation in geopolitical tensions and the resulting risk-off sentiment. In the United States, markets have remained under pressure, with the Dow Jones down 7%, the S&P 500 lower by roughly 5%, and the Nasdaq declining close to 4 to 5% over the period. Volatility has been elevated, with sharp swings driven by oil price movements and changing expectations around inflation and monetary policy. European markets too came under pressure early in the conflict, particularly due to their exposure to energy imports. However, losses have been more contained, with the Stoxx 600 broadly flat to slightly negative over the period. They were supported by a late rebound on easing oil prices and hopes of de-escalation. Across Asia, performance has been mixed. Japan and South Korea saw the sharpest swings, with South Korea's Kospi seeing a correction in the range of 12 to 13%. Indian markets extending gains for the past 2 days, but broadly remain under pressure. Among other regions, commodity-linked markets such as Canada have outperformed, benefiting from higher gold and energy prices, while emerging markets have broadly underperformed due to currency pressures and capital outflows. And while equities remain under pressure, the real volatility is visible in commodities and safe haven assets. Since February 28th, Brent crude has risen significantly, moving from the $70 per barrel range to a peak of above $100. Prices have since eased slightly, but remain elevated compared to pre-conflict levels. Now, this surge has been driven by concerns around supply disruptions, particularly through the key shipping routes, and has had a cascading impact across global markets. In contrast, industrial commodities have shown a more mixed trend. While supply concerns have offered some support, demand-side uncertainties, especially from China, have capped gains and led to a more subdued performance overall. Gold's trajectory since February 28th has been defined by sharp volatility rather than a sustained rally. In the immediate aftermath of the conflict, gold prices surged strongly on safe haven demand, briefly crossing the $4,600 per ounce mark. However, this rally proved short-lived. Prices have since corrected sharply. Now, despite the pullback, gold continues to remain significantly higher on a year-on-year basis, with gains estimated in the range of 45 to nearly 60%. In contrast, cryptocurrencies have remained largely range-bound. Bitcoin has seen mild declines over the period, with no clear evidence of sustained safe haven demand.